Welcome back to the channel. Today, we're diving into some proven strategies to help you reduce your investment risk. Because let's be real, nobody wants to watch their hard-earned money disappear, right? Investing always comes with some level of risk. That's just the nature of the game. But the goal isn't to eliminate risk entirely. It's about managing it effectively so you can achieve your financial goals over the long term. In this video, I'm breaking down 5 key strategies that can help you do just that. We're talking about practical steps you can take to protect your investments and sleep soundly at night, knowing you're on the right track. Let's kick things off with diversification, a concept you've probably heard before, and for good reason. It's all about spreading your money across different asset classes. Think of it like this. Would you rather put all your eggs in one basket or spread them out across several? The same logic applies to investing. By diversifying your portfolio, you're essentially reducing the impact any single investment can have on your overall returns. If one stock tanks, you won't lose everything because you have other investments to cushion the blow. Now, when we talk about diversification, we're not just talking about picking a bunch of random stocks. It's about strategically allocating your money across different asset classes like stocks, bonds, real estate, and even alternative investments like gold or cryptocurrency. Each asset class has its own risk and return characteristics. Stocks, for example, have historically delivered higher returns over the long term, but they also come with more volatility. Bonds, on the other hand, are generally considered less risky and provide a steady stream of income. By diversifying across different asset classes, you're creating a balance in your portfolio. When one asset class is down, another might be up, helping to smooth out your overall returns over time. Think of it like building a well-rounded sports team. You wouldn't want a team of all quarterbacks, right? You need a mix of players with different skills and strengths to succeed. The same goes for your investment portfolio. By diversifying across different asset classes, you're building a team of investments that can weather different market conditions and help you reach your financial goals. Next up, let's talk about dollar-cost averaging, a strategy that can take the emotion out of investing and potentially reduce your risk over time. Look, we've all been there, watching the market go up and down, trying to predict the perfect time to buy or sell. But here's the thing, trying to time the market is incredibly difficult, even for seasoned investors. It's like trying to catch a falling knife. You're more likely to get hurt than to succeed. That's where dollar-cost averaging comes in. This strategy involves investing a fixed amount of money at regular intervals, regardless of what the market is doing. So whether the market is up, down, or sideways, you're consistently investing the same amount. Now, you might be thinking, but what if the market is down? Won't I be buying at a loss? And you're right, you might be buying some shares at a higher price and some at a lower price. But over time, this strategy can actually help you average out your purchase price and potentially reduce your risk. Think of it like filling up your gas tank. You wouldn't wait for the absolute lowest gas price before filling up, would you? You'd probably fill up regularly, regardless of the price fluctuations. Dollar-cost averaging works in a similar way. By consistently investing over time, you're taking advantage of market dips and potentially buying more shares when prices are lower. This can help you lower your average cost per share and potentially maximize your returns in the long run. Now let's move on to asset allocation, which is all about finding the right mix of investments for your individual needs and risk tolerance. Remember how we talked about diversification earlier? Well, asset allocation takes it a step further by determining the specific percentage of your portfolio that you want to allocate to each asset class. This is where things get personal because the right asset allocation for you depends on a few factors, including your age, time horizon, and risk tolerance. For example, a younger investor with a longer time horizon might be comfortable with a more aggressive asset allocation, meaning they might have a higher percentage of their portfolio in stocks. This is because they have more time to recover from any market downturns. On the other hand, an older investor who's closer to retirement might prefer a more conservative asset allocation with a higher percentage in bonds. This is because they have less time to make up for any losses, and might prioritize preserving their capital. The key here is to find an asset allocation that aligns with your individual circumstances and risk tolerance. There's no one-size-fits-all approach, and what works for one investor might not work for another. A good way to approach asset allocation is to think about your investment goals. Are you saving for retirement, a down payment on a house, your kids' education? Once you have a clear understanding of your goals, you can start to determine the right asset allocation to help you achieve them. Alright, so you've diversified your portfolio, implemented dollar-cost averaging, and found your perfect asset allocation. Great, but the work doesn't stop there. It's important to regularly review and adjust your portfolio to make sure it's still aligned with your goals and risk tolerance. Think of it like getting regular checkups at the doctor. You wouldn't wait until you're seriously ill to see a doctor, right? You'd go for regular checkups to catch any potential problems early on. The same goes for your investment portfolio. Life happens, your financial situation changes, and markets fluctuate. That's why it's important to regularly review your portfolio and make adjustments as needed. How often should you review your portfolio? That depends on your individual circumstances, but a good rule of thumb is to review it at least once a year, or more frequently if there are any major changes in your life or the market. During your portfolio review, you'll want to consider a few things. First, check your asset allocation. Has it drifted from your target allocation due to market movements? If so, you might need to rebalance your portfolio by buying or selling certain assets. Next, take a look at your individual investments. Are they still performing well? Are there any new investment opportunities that align with your goals? This is a good time to do some research and make any necessary changes. Remember, investing is a marathon, not a sprint. By regularly reviewing and adjusting your portfolio, you're ensuring that you're on track to reach your financial goals, and that your investments are still aligned with your risk tolerance. Finally, let's talk about risk tolerance, which is arguably the most important factor to consider when it comes to investing. Risk tolerance refers to your ability and willingness to handle fluctuations in the value of your investments. In other words, how much risk are you comfortable taking on? Are you someone who can stomach seeing your portfolio drop 20% in a year, or would that keep you up at night? Understanding your risk tolerance is crucial because it will dictate the types of investments you should be making and how your portfolio should be structured. If you have a high risk tolerance, you might be comfortable with a more aggressive investment strategy that includes a higher percentage of stocks. You understand that while stocks can be volatile in the short term, they have the potential for higher returns over the long term. On the other hand, if you have a low risk tolerance, you might prefer a more conservative investment strategy that includes a higher percentage of bonds. You prioritize preserving your capital and are willing to accept lower returns in exchange for less volatility. There's no right or wrong answer when it comes to risk tolerance. It's all about finding what you're comfortable with and what aligns with your financial goals. A good way to determine your risk tolerance is to think about how you would react to a significant market downturn. Would you panic and sell all your investments, or would you see it as a buying opportunity? Once you have a good understanding of your risk tolerance, you can start to build an investment portfolio that aligns with your individual needs and goals. Thanks for watching. If you found these strategies helpful, don't forget to like, subscribe, and hit the notification bell for more investment tips. Remember, investing doesn't have to be scary. By understanding these strategies and taking a proactive approach, you can manage your risk effectively and work towards achieving your financial goals. As always, do your own research, consult with a financial advisor if needed, and make informed decisions that align with your unique circumstances. Here's to making smart investment choices and building a brighter financial future.